In this session, we will primarily be looking at the concept of utility theory, wherein a few major elements that would get covered are the clear understanding of utility function. What do we mean by that? What do we first of all mean by utility? And then what do we mean by utility function? What is this expected utility theorem? So how do I define that particular theorem, and on what kind of axioms that I can do a calculations related to the expected utility? Then from each customer or investor perspective, what are the various economic characteristics? What are the various economic characteristics of each of these customers, of each of these investors with respect to the utility? So we'll be talking about a few important terms like a non-satiation. We'll discuss about what each of these definitions do mean. I will look at an important concept in the which will form the base for the portfolio theory, which is called as a risk aversion. How do I measure this risk aversion in terms of the utility function? Risk neutrality of the investor. How do I differentiate whether the investor is a risk seeking or risk neutral or risk averse kind of investors? Uh, I am primarily looking at how do I analyze these important concepts in this risk aversion. Also, what are the various mechanisms that are available for me to measure this risk aversion of the investor? So how do I do it in absolute terms? How do I do it in relative terms? We'll have a discussion of each of these concepts. Then we will also go ahead in terms of discussing the commonly used utility functions. So we will talk about a quadratic function, we'll talk about a power function, a few of them. So commonly used utility functions is what we are going to discuss, and how this current the various utility functions which I am talking of, how can I connect? How can I connect the utility function based on the current wealth or state dependency, the current state of the individual? We call them as state dependency associated with the utility function. And I would also like to look at not only from the investor's perspective, even from a consumer's perspective. Even from a consumer's perspective, how do I use the utility and utility maximization kind of concept? Because at the end, I want to invest where my utility is maximized, or I want to, from a consumer standpoint, I want to purchase that particular good or service where my satisfaction or utility is maximized. So using this, we'll try to do a few calculations, both from an investor standpoint as well as from an individual customer standpoint. And towards the end, we would be discussing about a concept called dominance theory. We'll try to find out what is this first order and second order kind of dominances, and how does this concept of dominance go with the utility theory. So these are the various aspects that we are bringing as a part of this session. So primarily, the first point is to understand the utility theory, because in a lot of applications in the financial space, this concept of economics plays a very key role. Because if I look at it from a common man's standpoint also, utility. Utility is more linked with what is called as satisfaction. Am I correct? Utility is something that people link it with satisfaction. On any kind of a decision, now you can think of whether you would be looking at it as a consumption related or a purchase related decision, or it could be an investment related decision, any kind of a relation where you are trying to spend. You would like to spend on that particular good or on that particular investment which is going to enhance your utility, means which is going to give you a bigger satisfaction compared to the other. So there should be some kind of a mechanism to measure this satisfaction levels, and that is what we are trying to understand from this particular session, or whenever I talk about the utility functions and utility theorems and all that stuff. The major focus is getting driven in the form of how do I measure the satisfaction levels. So probably this is a concept which is more to do with measurement of satisfaction levels of the consumers as well as the investors, depending on what is the underlying instrument that we are talking of. We could be getting into the computations and analysis of the satisfaction levels of the consumers and the investors using this utility concept. So that is where now when I look at from an investor perspective, if I want to first understand the utility of the investor, and probably if the investor is having multiple choices to invest, and each of these choices has some level of uncertainty, because let's say if the investor has to choose investing between stocks, mutual funds, and let's say real estate. Now these are the three choices that are available to the investor, and based on these choices he wants to take a decision where he needs to invest and by what extent. So my point from an utility theory dimension is, okay, each of these different forms of investment have some level of uncertainty. Probably yes, stocks can give either 15% return in a year, or there is a chance that I may lose 10% in a year. Probably mutual funds, either it is plus 10% or minus 5%. Real estate, either it is plus 25% or minus 40%. Some such kind of numbers. If I gain, there could be a huge gain. If I lose, there could be a huge loss. For different kinds of investment, this kind of profiles could be different. Now, what we are saying is, from any investor's perspective, I'll try to compute the utility function. The utility function is some kind of a formula. Utility function is some kind of a formula which will compute the utility as a numerical value. Utility is some kind of a numerical value which is coming out from a particular formula associated with it, and for each choice I will compute this numerical value for stocks, for bonds, for mutual fund. For each kind of option that is available, I'll try to compute this utility value using this particular formula, and this particular formula is what we call as utility function. Sometimes we use a logarithmic function. So probably as a quick example, I may say utility function of W is something like log W, where W is the wealth of the person, right? Utility can be expressed in as some kind of a function of wealth. So just as an example, I have used this particular function saying utility of W is equal to log of W. So depending on whichever option gives the highest value of the logarithm, highest value of utility would be the choice for that particular kind of customer. So that is where we use the utility functions. Generally, the commonly used ones are logarithmic function or power function. We'll discuss a few more such kind of utility functions slightly later in this session. So this is the one that is going to be discussed using this utility function. The utility function is nothing but it's a formula which is helpful to compute the utility values for the various options that are available, various choices that are available to the investor, so that he can apply that function effectively and make an effective choice about his investment decision. And this utility function in some cases is also called as preference function, because this is the one that is helping us to come out with appropriate preferences. So this is also called as preference function in some contexts. Alright. Now, just as a small extension to this concept, we are talking about expected utility. See, when I am talking about utility for each investment choice, whatever is the outcome, whatever is the outcome, we are using a utility function and trying to compute the utility. So what we are simply saying as a part of the expected utility theorem is, at any point in time in future, at any future date, we can compute the expected utility for a particular choice of investment. Expected utility, because for the future we may assume that the investor's wealth is going to be either this or this or this or this, with some kind of a probability for this, some other probability for this, because sometimes within 1 year, if the investment is successful, then his wealth may become this much. Semi-successful, his wealth may become this much, or probably a slight loss, the wealth may become this much. It's an utter flop, the wealth may become this much. So what we are typically looking at is, based on our expectations about the moment of that particular investment in future, we are trying to find out the expected utility, utility of the particular customer for towards a particular form of investment. So we are trying to express this utility function. We will be able to construct this utility function of a customer or an investor at a future date. And out of the various investment choices that are available, we can compute the utility value for the customer for different choices of investments at a future date. But we can always look at maximizing that particular utility, maximizing that particular maximizing that particular expected utility for the customer towards a particular investment, based on what, using the probabilities and trying to compute probability multiplied by the expected utility for each of the investments. I can get this, and whichever the one that gives the maximum utility out of the various available ones, that is what we are going ahead as an investment choice. Just for an example purpose, let's say the current wealth of the investor is 50 bucks, right? The current wealth is 50. Now he is looking at an investment X, and I know that the investment X can either lose 10% or gain 15%, let's say with 50-50 probability. So the probability of losing 10% in 1 year is 0.5, gaining 50% in 1 year is around 0.5. And let's say the utility function I'm looking at is a logarithmic function itself. Now I want to know, first of all, whether this particular investor will be better off investing nothing or investing everything in X, the whole 50 which he is having, or investing partly in X. There are three choices that are available. Don't invest anything, invest everything, invest partly. Partly could be in some proportion. Now what we are saying is, you try to find out in which case the utility for the customer is maximum. In the first case, because he is not investing anything, even after 1 year his wealth is going to be 50 itself, which means his utility function is going to be log 50. Whereas in the second case, let's say he has invested everything into X, so that everything into X. Now there is a possibility that his wealth can be down by 10%, means there is a possibility that it can go to 45 with a 50% chance, and it can go up by 15%, which means it could go to 57.5. So his utility function could be either log 55 or log 57.5, and both of them are having equal probabilities. So his expected utility at that after 1 year, if he is going with investing everything in X, is going to be something like this. Now whereas in the third case, let's say he is investing some A percentage, he is investing some A percentage in X, and he is just staying away with the remaining, which means probably he has invested, right, out of this 50, some A percentage, A by 100, let's say he has invested in X, and out of this 50, 1 minus A by 100, he did not invest anywhere. So it's as good as probably A by 2 he has invested somewhere. A by 2 he has invested in X, and probably 50 minus A by 2 he did not invest anywhere. So because he did not invest this much, it's always, let's say, so because he has invested A by 2, there is a possibility that A by 2 can be down by 10%. Means it becomes 0.9 A by 2. Correct? A by 2 can be down by 10%, so it can become 0.9 A by 2. Similarly, A by 2 can increase by 15%, so it can become 1.15 A by 2. Which means at the end of 1 year, his total wealth could be either 0.9 a by 2 plus 50 minus a by 2, because this does not change, or it could be 1.15 a by 2 plus 50 minus a by 2. So overall it looks as if his wealth is going to be 50 minus 0.1 a by 2, 0.9 a by 2 minus a by 2, minus 0.1 a by 2. So this could be possible in 50% of the cases. So I'll take 0.5 log this much being the utility function, or it could be 1.1, so 0.15 a by 2 plus 50. I'll take the logarithm of this and take 0.5 times this. So in the first case, the utility is going to be this much. In the second case, the utility is going to be this much. And in the third case, the utility is going to be this much. So probably let's try to calculate what is the utility that is coming out in each of these three cases. So in the first case, I am looking at log 50. Log 50. Coming to 3.91. Okay, in the second case I want 0.5 times log 45 plus 0.5 times log 57.5. So in the second case this is becoming 3.92. So slightly a higher kind of utility. And what about the third scenario? Let me see, 0.5 times. Okay, let's say this is some A, right? A probably for time being, let's assume that I am investing 20% in it. I'll take 20, not 20%. I'll take it as 20. I'll take it in the number format. Okay, so here I'll take it as 0.5 times log 50 minus 0.1 a by 2. 50 minus 0.1 a by 2 plus 0.5 times log 50 plus 0.15 a by 2. 50 plus 0.15 a by 2. Okay, so if I am going with 20%, probably the utility is this much. But if I go with 40%, then the utility has gone up. So I can think of maximizing this. Right? Maximizing this means nothing but take the derivative of this particular function. Yes, 0.5 divided by 50 minus 0.1 a by 2, and the derivative of this is minus 0.1 by 2 multiplied by minus 0.1 by 2. Similarly, I take the other side, 0.5 divided by 0.15 a by 2 plus 50. This I am multiplying with 0.15 a by 2. Now I can think of equating this particular thing to 0 and finally computing the value of a. I'll take the help of this spreadsheet to compute the value of a. I'll try to maximize this particular value by changing this. So I'll take the help of a feature called solver, whose intention is to, where I will set the equation as maximize this by changing this particular value. That's it. So probably I'm getting a better solution, or probably here I may have to say that it can't be more than 1. So I'll put one constraint also saying that this particular number should be less than or equal to 100 only. In this has come out to a slightly, it has come out to a mechanism saying I invest entire 100% of it. This is going to do the maximization job for me. So, what in some cases this equation may not be a possible equation. Somewhere in the middle, the utility can come out to be maximum. Probably 50% investment could maximize the utility. So, we may have to really find out what is an ideal combination to be invested so that the utility is getting maximized. But just on a conceptual understanding perspective, I'm trying to bring out the various possible investment choices that are there. We are trying to compute the utility for the various investment choices using the appropriate utility function, and based on that we are trying to make our investment choices. And a few important uh, concepts are probably what we call as axioms that play an important role in coming out with the expected utility theorem, wherein we make a few important will make a few important points to be looked at when we are deriving our expected utility theorem. One, we talk about comparability. Investor is comparability. So what we can say is investor can really compare between two choices. The outcomes of the two choices that are available to the investor, he is comfortable enough in comparing the outcomes of the two choices. Either he is able to make a choice saying A is much preferable than B, or B is much preferable than A, or he is indifferent between A and B. Based on the computation of the utility, A can always compare the utility or the satisfaction that he is able to derive between the two outcomes. And the second important concept that comes in this possibility is the transitivity property, which says if at all an investor is preferring A over B because of the utility, he is preferring B over C, then automatically it becomes that A gets preferred over C itself. From the utility perspective also, if I see that the utility of A is greater than the utility of B, the utility of B is greater than utility of C, under the transitivity property, I can definitely take that the utility of A is greater than the utility of C. Similarly, even with the equalities, in terms of ranking of the investments, this particular axiom comes very handy. Then we also talk about another property called independence. The independence property says if from a utility standpoint, if I find that the utility of A and utility of B are same, then let's say there is one more opportunity which is C. Let's say there is one more opportunity which is C, then what we are saying is the investor will be really indifferent between this and this and this and this, either this and this or this and this, provided C is a kind of independent event. Let's say going with an investment gamble wherein he is going to get A with a P probability and C with 1 minus P probability, or B with P probability and C with 1 minus P probability, he is really indifferent, because he is indifferent between A and B investment opportunities. So if he wants to go with a combination of A and C or a combination of B and C, he is really indifferent to those also. This is what is the principle of independence that is coming up. And one more important axiom that is driving this expected utility theorem is a certainty equivalence. Very important concept, a certainty equivalence. Probably if I am looking at, let's say, three choices A, B, C. Utility of A is greater than utility of B, which is again greater than the utility of C. Now, what we are simply saying is, there always exists one unique probability, wherein I can construct the utility of B equivalent to that unique probability multiplied by utility of A plus 1 minus P times the utility of C. So, I mean, the investor can really be indifferent between investment in B versus a proportion of investment in A and the proportion and the remaining proportion of investment in C. There always exists one single probability P with which you can construct the equivalence of the utility of B. So this is where we call B as the certainty equivalent of A and C. A is something where the utility is much higher. C is something where the utility is much lower. There could always be a combination by going with an investment of P in A, 1 minus P in C, and you can construct a utility which is more or less equivalent to that of B. So this is what is the certainty equivalence axiom. So these four important axioms, they actually drive, and they are the most commonly used kind of concepts as a part of building the expected utility theorem process. Alright. Now, the next important concept which I would like to bring out here is, how do we really look at some of the attitudes of the investor, some of the typical attitudes of a common investor in terms of utility function. Few of those commonalities which I typically look at, one being the concept of non-satiation. Of course, before I discuss a little bit more on it, see, we typically understand this fact. Well, see, there are so many investment products that are available. There are stocks, there are bonds, there are mutual funds, there is a real estate, there is a bank deposit, and probably you can think of many more such kind of instruments that are available in the market. Now, different investors are preferring different investment vehicles, or probably different combinations in this investment vehicle. Why so? The prime driving factor behind that is nothing but their attitude towards risk. Some investors are high risk taking investors, whereas some investors don't want to go with the risk, and we have already defined risk as uncertainty. In some investment, there is high level of uncertainty. Either the gain could be very high or loss could be very high. The uncertainty levels are very high. Whereas in some other securities, that uncertainty levels are much lesser. Probably if I am going for a fixed deposit on a bank, the uncertainty levels are much lesser. So the uncertainty is the risk part. So based on the attitude of the investor towards risk taking, that particular investor is choosing his investment opportunities or investment vehicles. So from that dimension, it is getting very clear for us that unless I understand the risk taking levels of the investor, that risk taking levels of the investor, we are trying to measure in the form of using the utility functions itself. So from that concept is coming one important theory or one important behavior of the consumer, which is the non-satiation behavior. Generally, investors will prefer more than less. As long as he is gaining more and more, he will prefer it compared to he is losing. So what we are simply saying is the marginal utility of wealth means that extra wealth that is getting created by an extra investment. Marginal utility of wealth is always positive because investors always prefer more wealth compared to less wealth. So if they are convinced that their wealth is going to increase, they are going to go for that investment, and if they feel that their wealth is going to decrease, they will not. So the marginal utility of wealth will always be positive as per the non-satiation principle. Now the other important principle which is worth consuming or worth understanding is the classification of investors. Very important dimension. So here probably when I am saying marginal utility of wealth, probably it's the first derivative of the utility of wealth, which should be positive. That's one important thing that we are looking at. Then from the second dimension, I am looking at the classification of the investor. Here we are talking about three major classes of investors. One being the most common one, who is called as a risk averse investor or risk seeking or risk loving. We generally call risk seeking investor or risk loving investor, and probably here I am looking at risk neutral investors. So these are the three major categories of investors from the perspective of their risk taking abilities. And these three kinds of investors, if I have to express their utilities, their investment, their behavior in terms of utility function, it comes out straightforward. The second derivative of the utility function is negative for the risk averse persons. We'll see why it is. The second derivative of the utility function is positive for risk seeking guys, and the second derivative of the utility is zero for the risk neutral investors, because whenever we are talking about risk averse, we are talking about a person who does not prefer taking risk that easily. So though you tell him that there is a chance of making a gain, and there is an equal chance of making a gain as well as a loss, he does not go for that gamble. If you say that there is a chance of there is an equal chance of making a gain as well as a loss, wherein the expected utility is not changing, is constant, even then this person will not go for that gamble because he gives less weightage to the possible gain, more weightage to the possible loss. So he's following more of a cautious kind of an approach. He gives more weightage to the downward side and he gives lesser weightage to the upward side. So for him, the expected utility is not the same, is actually on the downward side. So that is what is the characteristic of a risk averse investor. Though there are equal chances of gain and loss, for him he will give a lesser weight to the gain and he gives more weight for a loss, and that is where he will not go with that fair gamble. And just to give you some more inputs into it, the risk averse investor is the most common behavior we take in valuing, in computing the value of any financial instrument. We'll be seeing that all derivative instruments or probably all equity instruments, they are valued. Their fair value is computed under the assumption of the investor being risk averse itself. So that is where the characteristics of the risk averse investor form more and more important in the investment theory, in the portfolio management theory. A lot of concepts driving the world of investments, and which is as simple as he gives less importance to the gain. So in order to motivate him for a risky investment, he should get much more in terms, he should be the return, the expected return to should be much more compared to the additional risk that is being taken. Compared to the additional downside, the upside should have much more better prospects. So he is ready to trade off on the lower expected wealth. So even if the expected wealth is much lesser, he is ready to trade off on that. He is ready to get a lesser expected wealth, even but he does not go with any kind of variability in terms of his wealth. So that's one of the prime reasons when I look at the utility function curve for a risk averse, it looks more and more concave. The utility curve is more and more concave because you will find that the marginal utility decreases with the level of wealth. If I am taking wealth here and utility of wealth here, the it marginal utility, it decreases. That's the reason the second derivative, the change in the marginal utility is negative. Marginal utility decreases with the wealth, and that is the characteristic of a risk averse investor. But looking at on the other side, I can look at risk seeking or risk loving. The marginal utility is positive. So which means now you could see, if you are presenting him with an opportunity which has an equal chance of a gain and a loss, he gives more importance to the gain because he is ready to go with that gamble, and he gives less importance to the loss. So even though the expected loss is going to be much lesser, he is ready to go with that because he sees the positive side in it. He is looking at the chances of increase in the wealth. So he is giving more weightage to the increase in wealth rather than an incremental decrease in the wealth. So that is where we see that the second degree or the derivative of the marginal utility function or the second derivative of the utility function is going to be positive. So he is like a risk seeking. Even though there is a slightest possibility of a gain, he is ready to go for it because he is looking at the potential increase in his wealth rather than the downside where his wealth can go down. So his graph, his utility function will always be convex in shape. Whereas coming to the risk neutral investor, the second derivative of the utility function is always 0 if he is presented with gain and loss with equal probability, he weighs both of them to be the same. So he is going more from an expected expected utility function. So he is indifferent between either staying neutral or going with this gamble which has equal chances of gain as well as the loss. So that is how we try to look at the utility using the utility function. We can really try to understand whether this particular investor is a risk averse investor or a risk seeking investor or a risk neutral investor. So understanding these kind of common behaviors like non-satiation, classifying the investor based on his risk appetite or risk attitude will be one of the most important activities in terms of providing investment suggestions or investment advisory to the different classes of investors. Now that is where we get into the mechanisms in terms of the calculating the risk aversion, because one of the most important behavior or characteristic of the investors we look at in terms of valuation is the risk aversion, because no investor wants to take the risk if there is no possibility of getting a higher expected return. Only if there is a possibility of getting a higher expected return, that is where an additional risk taking behavior will come into picture. So how do I calculate this risk aversion levels, right? How do I look at the certainty equivalent of that? How do I calculate the risk aversion levels in terms of absolute as well as the proportionate cases? All these things we would be covering up now as a part of this calculating process. All right. So as we have seen just a while back, that by looking at the second derivative of the utility function, we can very well assess whether that particular investor is risk averse or risk loving or probably risk neutral. Along with looking at just this function, we are also interested in seeing by what extent this risk aversion levels change with the existing wealth. Change with the existing wealth. So it's always necessary for us to compare the levels of risk aversion with its certainty equivalent. We can actually look at the certainty equivalent of various positions, and based on that we can really assess whether the risk aversion levels are increasing with wealth or decreasing with wealth. For example, if I assume that the current wealth of a person is $1,000, and now there is a gamble that is available for him, which is a fair valued gamble, saying he can gain either $100 or he will lose $100 with equal probability. Right? If I'm looking at his position, which means he can his wealth at a later date could either become 1100 or 900. Right? So now, just to check out what is his position here. If I'm taking it into a spreadsheet, the first scenario where there is no, he is not getting into a gamble, which means his wealth is going to remain at 1000. Then his utility value is around 6.9, assuming that his utility function is a logarithm function, log w. I'm looking out that his utility is 6.9, but if I'm assuming that he has gone for this gamble, so it would be like zero point 0.5 times log 1100 plus zero point 0.5 times log 900. This is going to be his certainty equivalent, slightly reducing. This is going to be the utility function in case he is going ahead with the gamble. Which means if I look at the certainty equivalent of this by taking the reversal of the same, his wealth is going to be only 994.98, which means he is experiencing a loss of around 5.01. So what do I understand from this? The certainty equivalent part. The certainty equivalent part will always be negative in case of a risk averse investor, because the risk averse investor, we could see that this value will always be negative because he has to be compensated for accepting the gamble unless he gets, if the expected return is same as not getting into the gamble. Here, if it is a 50% chance of getting 1100 and 50% chance of getting 900, the expected value is still 1000 itself. So, if the expected value is 1000, he is always looking at not getting into the gamble because his 1000 is already assured here. So the certainty equivalent of this gamble is only 994.98, which means so to it is equivalent to only 994, whereas if he does not get into the gamble, his wealth is equivalent to 1000, so he will always prefer this, right? So unless he feels that okay, there is a 70% chance of getting 1100 and 30% chance of getting 900. If that is the case, what is going to be the expected value of the wealth? 70%, 77 plus 27. 77 plus 27 making it as 1040. So the expected value is increasing. So from that perspective, probably he may look at evaluating this particular option when there is a 70% chance, let's say, of getting let's say of getting 1100 and only 30% chance of getting 900, then probably his certainty equivalent is going to 1035, and then he is accepting the gamble. So whenever you see that if it is a fair gamble, you will always find the certainty equivalent for a risk averse investor to be very much negative itself. So looking at that particular context, one point that I can very definitely make is the certainty equivalent for a fair gamble will always be negative, and that is what is a representation of risk averse investor. Then one more important thing which we are interested in seeing is this risk aversion increasing with wealth or decreasing with wealth? Is it increasing with wealth or decreasing with wealth? Here if you see, if I have observed 1000 as the wealth of the person, just to note it down, if I have observed 1000 as the wealth of the person, then I have seen that the certainty equivalent is minus 5.01. But here I'll assume that the wealth of the person, let's say it has become 2000. If it has become 2000, then a gain of 100 will take him to 2100 and a loss of 100 will take him to 1900. Now what I am seeing is the certainty equivalent is just become half. For 2000, this has just become minus 2.50. Right, so what we are typically seeing in this case is, as the wealth is increasing, the certainty equivalent in terms of magnitude is actually decreasing. Right, the certainty equivalent in terms of the magnitude is decreasing. So what my point to say is, if this certainty equivalent, whatever we are computing, if the certainty equivalent decreases as the wealth is increasing, if the certainty equivalent is decreasing, then we are saying that that particular investor is having absolute risk aversion levels are declining, absolute risk aversion. Whereas if I see that the certainty equivalent is increasing as the wealth is increasing, then I am saying that increasing absolute risk aversion levels are being exhibited by the investor. Sometimes I look at this certainty equivalent in absolute terms, which is directly looking at how many rupees or dollars is the difference. I can look at it in absolute terms, or sometimes I can look at it in proportionate terms, which is nothing but certainty equivalent as a proportion of wealth. Now in this case you could see this is the certainty equivalent. So certainty equivalent as a proportion of wealth is going to be this much. Here also certainty equivalent as a proportion of wealth is going to be this much. Even in this relative scale also I have seen that this value is much lesser compared to this particular value. This is much higher. So the so either we express the certainty equivalent in its original absolute form itself, or we are trying to express it in terms of percentage. So whenever we look at the actual absolute value, then if it is decreasing with respect to wealth, we say that declining absolute risk aversion. If it is increasing with respect to wealth, we say that the investor is exhibiting increasing absolute risk aversion. The same way, if with the wealth, if the proportion is declining, we say that the investor is exhibiting declining relative risk aversion. And if the proportion is showing an increase, then we say it's an increasing risk, relative risk aversion. Now in this example, both there is an increasing absolute risk aversion as well as increasing relative risk aversion also for this case, because in both the cases I am seeing with the increase of wealth the certainty equivalent value is increasing itself. So at least for this example we see that both absolute risk aversion as well as relative risk aversion levels, both of them are showing an increasing kind of a pattern itself. Now how do I measure this absolute and relative. Absolute and relative risk aversion levels. How do I measure them in terms of using the utility function? That's one more important aspect that we are supposed to look at. Now, expressed in utility function terms, I can measure the absolute risk aversion, which is represented by A of W. It says that I can measure absolute risk aversion by taking the negative of the second derivative of the utility function and dividing it by the first derivative. This is what is a measure of the absolute risk aversion, whereas when I bring in the relative risk aversion measure, I'm just multiplying the same with the original wealth because I'm looking at from a proportion perspective. So minus W times the same, the second derivative of the utility function of wealth divided by the first derivative of the utility function of wealth. So these are typically, just to understand, these are typically called as Arrow-Pratt measures of absolute and relative risk aversion computation. So generally, when we look at the computing the expression for absolute risk aversion or relative risk aversion, I look at these expression, and the good thing is the moment I take their derivatives, their first derivative, either the absolute risk aversion's first derivative or relative risk aversion's first derivative, I can actually conclude that if this first derivative is positive, then I can say that it is an increasing absolute risk aversion. If it is negative, I can say that the investor is exhibiting decreasing risk aversion, absolute risk aversion. And if it is zero, I can say that the investor is exhibiting constant absolute risk aversion. The same thing goes with the relative risk aversion also. Positive means increasing, negative means decreasing relative risk aversion, and zero means constant relative risk aversion. So we can very well take the first derivative of the absolute or relative risk aversions to understand whether the investors' absolute risk aversion levels are actually increasing or decreasing or staying constant, and same is the case with the relative risk aversion levels. So generally what we see is, okay, let's think about an investor whose wealth is some $1,000. Now, if a significant amount, let's say 900 or 800, significant absolute value of his amount is in risky assets, and now what we see is as his wealth is increasing, let's say from 1000 to 2000, he will be exhibiting declining absolute risk aversion. As we have seen in the earlier case, his risk aversion levels are going to go down because we see that the certainty equivalent value is actually increasing. Similarly, the other way we could look at is a person who is having a highest proportion of investments in risky assets, then we see that as his wealth is increasing, he is exhibiting a decreasing relative risk aversion level. So probably what we could really try to link is the current wealth levels, current status level and based on that, as his wealth increases, whether he would be exhibiting an increasing or a decreasing absolute or relative kind of risk aversion levels is something which we can understand from this particular process, right? Now let's try to see some of the commonly used utility functions. Some commonly used utility functions, and let's try to apply all these concepts which we have understood till now. Let's say I want to start off with the log function itself, which we have been discussing for quite some time in a couple of examples. So I'll take the utility function as a logarithm. Then what does it mean? U of w, which is the utility value, is I'm taking it as log w. Fair enough. So obviously, because the logarithm is defined only for positive numbers, w is greater than 0 and w is nothing but the wealth, so which should also be greater than 0 itself. Now let's try out these concepts. U dash of w, which is the first derivative, which will come out as 1 by w. U double dash, which is the second derivative of the utility function, which comes out as minus 1 by w square. Now, if at all the two important rules that need to be satisfied by the utility function, the non-satiation, which we have discussed earlier. In case it has to satisfy the non-satiation fundamental, the u dash of w should be greater than 0. 1 by w. 1 by w obviously is greater than 0 because w is greater than 0. So directly non-satiation principle is directly applicable. And what about the diminishing marginal utility? Always every utility function which we are looking at, we have to first check for these two because only based on this we can say that the utility function is applicable. So the diminishing marginal utility rule says the second derivative should be less than 0. So minus 1 by omega w squared. W is positive, so this value is less than 0. So directly the log utility function for all w's is satisfying both the non-satiation principle as well as the diminishing marginal utility principle, right? Now from here I can find out the absolute risk aversion, which is minus the second derivative of the utility function, which is minus 1 by omega w squared divided by the first derivative. So this is becoming 1 by w, right? This is a positive number, fair enough, but if I am looking at a dash of w, which is the derivative, that is what will give me whether the investor is exhibiting absolute increasing absolute risk aversion or decreasing absolute risk aversion or constant. So this is coming out as minus 1 by w squared, which is less than 0. So which means the investor who is exhibiting a log utility function will exhibit a decreasing or declining absolute risk aversion mechanism. Then what about relative? Yes. So if I have to find R of W, the relative risk aversion, minus omega minus W times my second derivative divided by first derivative. So this is becoming 1. And r dash of w is becoming 0, which is like a constant, which is neither a positive nor a negative. It is 0. R dash is 0, which means it is exhibiting a constant relative risk aversion. Constant risk relative risk aversion. So a simple way to understand or simple way to exhibit is, if the utility function is a log function, it exhibits a decreasing absolute risk aversion, whereas it exhibits a constant relative risk aversion, right? So utility functions, especially those kind of utility functions which are exhibiting constant relative risk aversion, are actually called as isoelastic. Those kind of utility functions which exhibit constant relative risk aversion are called as isoelastic, which is nothing but the elasticity of the marginal utility is constant. Even though if the wealth is increasing, you find that constant relative risk aversion, the relative risk aversion levels are constant. So, so this can actually help in terms of making, especially making investment decisions where the focus is only the current period and need not focus on the future periods, as the relative risk aversion levels remain constant at the end of every period. So the multi-period investment decisions really need not be focused too heavily, because I can take a decision today by visualizing the consequences at the end of the next period itself, rather than thinking 10 years down the lane, or very futuristic kind of an outlook. So that is an advantage, especially if my utility function follows a log kind of a pattern. Similarly, and now I can look at the next set of function, which is the quadratic utility function. Just like the log, now I'll think of u of w is ax squared plus bx plus c, or aw squared plus bw plus c. This is a quadratic utility function. Now, even to this, I can find out u dash of w, giving me 2aw plus b, whereas u double dash of w, u double dash of w is giving me 2a, right? So these are my utility function and their first and second derivatives. Now I'll see how should the non-satiation rule work. The non-satiation rule for me says that u dash, the first derivative should be positive, which means 2aw plus b should be greater than 0. Whereas the diminishing marginal utility rule says that u double dash of w should be negative, means 2a should be less than 0, a should be less than 0. So a should be negative, right? And what about here? If 2aw plus b is greater than 0, I could see that w is greater than minus b by 2a. W should be greater than minus b by 2a, and because a is negative, a should be a negative, I could also see that w should, w 2a w is greater than minus b, and w is greater than minus b by 2a, whereas a is negative. So what I could very well see is the value of w should lie between minus infinity to minus, so here the w value, this should be positive, and because A is negative, so the W's range will be this to, if I see my W is minus 1 by 2A, this is becoming equivalent to 0. Right, if I am taking W to be minus 1 by 2A, this 1 plus B, so at the max it can go to minus 1 by 2A. So the W is lying between this particular limit. Okay, we can look at the absolute risk aversion level where I am taking it as minus the second derivative divided by the first derivative 2AW plus beta. Now that is where I can take the second derivative of it, the first derivative of it, right, minus 2A, I'll take it out, 1 by x minus 1 by x squared. So I'll take it as minus 1 by 2AW plus B whole squared, and when I'm taking the derivative of this it is 2A, so it is becoming actually 4A squared divided by 2AW plus B whole squared. This is actually a positive number. So that is where we can say that quadratic utility function exhibits an increasing absolute risk aversion. Whereas when I am looking at relative, yes, R of W minus 2A just multiplied by W divided by 2AW plus B. So from here I can very well find out the the first derivative of this. Okay, 2AW plus B, the derivative of it is minus 2A. Then again I have minus 2AW minus of, so otherwise I'll take out the minus out altogether. So this is 2A and minus 2AW times the derivative of this, which is 2A divided by 2AW plus B whole squared. So this is becoming minus of 4A squared W plus 2AB minus 4A squared W divided by 2AW plus B whole squared. Now it is anyhow coming out that minus 2AB divided by 2AW plus B whole square, which is also giving, because A is negative now, minus of minus is giving me plus. So this is coming out as a positive value itself. So because I am getting it as a positive value in this case, I'm saying that a quadratic utility function, it shows both increasing absolute risk aversion levels as well as relative risk aversion level. Whereas when we looked at the log function, it was exhibiting decreasing relative absolute risk aversion levels, whereas constant relative risk aversion level. So that is what is the difference that we are observing there. Then one more important function I may feel like looking at is the power based utility function. We are talking about a power based utility function where I am looking at the u of w as w power sum gamma minus 1 divided by gamma. So from this again I can find out the first derivative, right, 1 by gamma into gamma w per gamma minus 1. So obviously this is becoming w per gamma minus 1, and the second derivative w is positive, obviously the 1 is going to be positive itself. And what about the second derivative? It is coming out as gamma minus 1 w per gamma minus 2. So if it has to satisfy a diminishing marginal utility, I want gamma minus 1 to be negative itself. So gamma should be less than 1. That's one rule to show the diminishing marginal utility function. And of course, I want the first derivative to be positive. W per gamma minus 1 should be greater than 0. And any of gamma is less than 1, that should be sufficient. So from here, I can very well compute the absolute risk aversion levels, which is coming out to minus of the second derivative gamma minus 1 W per gamma minus 2 divided by the first derivative W per gamma minus 1. So this is coming out as minus of gamma minus 1 divided by W. And what we are seeing here is if I am taking the first derivative of the same, I'll take it as minus gamma minus 1 by W is given by minus 1 by W squared. So this is going as gamma minus 1 by W squared. Now I know that gamma is less than 1. So gamma minus 1 is negative. So I see that this is exhibiting a decreasing absolute risk aversion. Now the same logic, if I am going for relative risk aversion, I just need to multiply this by W, which gives me the relative risk aversion value as minus of gamma minus 1, and from here R dash of W comes out to be 0. So because it is 0, this is also a kind of isoelastic kind of a function. The power function is also an isoelastic function. It is exhibiting constant relative risk aversion. So it is also exhibiting a decreasing absolute risk aversion. So more or less from the behavior, both log utility function and power utility function are exhibiting more or less similarities as far as absolute risk aversion is concerned, or even the relative risk aversion levels are concerned. So however, you can very well go with exponential functions and many other kinds of functions also as a part of the commonly used utility functions. The intention behind all of them being understand what is the absolute risk aversion level as well as relative risk aversion levels. Is it exhibiting an increasing property or a decreasing property or some kind of constancy property with the increase in the wealth levels of the individuals. So out of these various functions, which function will satisfy to the needs of the individual, we can very well assess by creating a set of questions, right? Depending on whether the person is looking at taking more and more levels of risk or decreasing risk with the increasing wealth. So based on the various questions that we have asked, we can try to map these questions to each of the utility functions which we presume, and see which of them is resulting in the least squared error. So using a least squared error process, we try to decide which utility function is best suiting to the needs of the individual, right? That's the way out. Now, the next important concept within this same session I would like to go ahead is the concept of the consumer choice. Till now we have been focusing more towards the investors. Now I am looking at the consumer choice theory, wherein we are looking at spending with a purpose of consumption of goods, not with the purpose of investments and the investment returns. So basically, from the purpose of consumption, the first thing I look at is what we call as consumption bundle, which is nothing but a combination of the various goods and services. So combination of different goods and services is what I'm calling as consumption bundle. Now the biggest problem that always the consumer will face is which consumption bundle to choose. And so it is a set of goods and services which will really help him for a healthier, for a happier kind of a living. So what is that combination of that goods and services that need to be selected for deriving more and more satisfaction? That is what is the fix. But at the same time, the consumer is also having several set of constraints. It's just not a combination of goods and services. Every consumer may feel that he can be better off if he is having a four bedroom duplex house, or probably if he is having an Audi car, and probably many more such kind of luxuries. But every consumer is faced with a set of constraints also. Though we are talking about a set of goods and services that can enhance the satisfaction levels of the customer, he is also faced enough with various constraints also. Now the constraints are determined from three specific dimensions. One, we are looking at from the perspective of preferences. So the consumer always looks at a relative preference towards one bundle compared to the other bundle. But on the other side, okay, whatever his preference, there is a budget constraint. He is not having unlimited access to capital. There is a budget constraint. So whatever are the various consumption bundles that are available, apart from the preferences, relative preferences which he is looking at, he also has to focus on the budget, and based on these two, his decision point will vary. So even if there are 10 preferences that are available, he will see which of these 10 preferences are suiting his budget to a large extent. And that is where we talk about, from a preferences standpoint, we understand a few important aspects, saying the consumer, one is I am assuming here the consumer can really showcase his preferences quite effectively. He can rank the bundles quite effectively. This is better than this. So that is one assumption I am making up here. And the theory of non-satiation, preferring more to less. Consumer, even from a not an investment perspective, even from a consumption perspective, I always see that the consumer will try to prefer more of one good compared to less of another good. But at the same time, the utility, diminishing marginal rate, if he is having more and more of a particular good, his interest to have that good will decrease. Probably it's like this. I want more and more of luxurious products. But a person who is already enjoying luxury for a lot of years and who has access to too much of luxury, he may not give more importance to another luxury good that comes in his way. So, as the wealth is increasing, so the moment a person is having more of something, whatever he wishes to swap one extra unit of good, which is what I call as the marginal rate of substitution or marginal utility, that he is deriving as he reaches the peak, is as he is enjoying more and more of a good, the thirst to add a little bit more to it will actually grow at a much decreasing rate. So that is why we say the preferences generally go with the concept of diminishing marginal utility, which is nothing but that marginal utility keeps decreasing as you start consuming more and more of that particular good. After consuming it, the more and more you start consuming high quality grains or high quality cereals, probably after a certain point in time, your interest to consume more and more of it will actually go down. But for a person who has not experienced those high quality products, the moment he sees them for the first time, his satisfaction levels, he experiences them for the first time, his satisfaction levels will get multiplied many times. That is what we are saying. The more and more a person consumes one particular good or service, his interest in terms of consuming more of that particular good actually goes down. Now, if I have to really interpret all these statements, okay, the consumer can typically rank between the various bundles. Now, ranking between the various bundles is always based on the utility. And what we are saying is, to exhibit it in more of a conceptual form, we talk about a concept called as indifference curve. The indifference curve is a kind of a set of all goods and services of all consumption bundles which give similar level of utilities. All consumption bundles for which the person can derive similar levels of utility itself. That is what we are calling as the indifference curves. So probably if I have to draw some kind of indifference curves between a good X and good Y, probably I can draw it something like this. Having this much of X and this much of Y, right? This much quantity of X and this much quantity of Y, or probably this much quantity of X and this much quantity of Y. The consumer is really indifferent to both of them. That is what we call as the indifference curve, which means the satisfaction or the utility that he is deriving by consuming this much quantity of one good and this much quantity of other, or this two quantities of goods X and Y, is going to be more or less one and the same. That is what we are saying. The consumer can pick any combination on one indifference curve. So if I am saying these indifference curves are I1 and I2, the consumer can try to choose any combination of goods and services of X and Y because he derives similar layers of satisfaction from both of them. So he can very well rank the different bundles. So probably for him, these are giving more satisfaction compared to this. So he should be able to rank different bundles. So according to that particular consumer, all these different combinations of X and Y, they give the same level of satisfaction or same level of utility. Whereas this one might give a higher level of satisfaction or higher utility. So which means as long as a particular combination is on the same indifference curve, the customer is really indifferent to the choice, and the ones which are above the current indifference curve, the consumer feels that they are much better compared to the earlier ones. So we see that the indifference curves generally are convex to the origin. Something like this, where you find the closed end facing the origin rather than the inside end. And typically, what is that slope of this indifference curve? Is it more flat like this? Is it more steep like this? It is going based on the individual preferences and by what extent he is willing to sacrifice. By what extent he is willing to sacrifice one good for the other. Right, so that's where if he is willing to sacrifice more of x per 1 unit of y, we could see that it is more and more flatter. If he is willing to sacrifice more of y for just 1 extra unit of x, it's going to be more and more steeper. So marginal rate of substitution will determine the actual shape of the indifference curve for the consumer. And apart from this, the second important thing which we have to discuss is the budget constraint. Now, from here, yes, these are the different prices that are available for this particular good and service. But on one side, we have a constraint. The prices, they will not come down drastically. They are more or less fixed. The salary levels or the income levels of the person are more or less fixed. So there is some level of the affordability part. Probably yes, this could give more satisfaction compared to this, but can he afford it? So that's where I could see I can draw one line which talks about his budget constraint. Either this is his budget constraint. If either he can buy these many goods of Y, these many units of Y, or these many units of X. So that is what he can afford based on his salary levels, based on his income levels. Now, all that we need to see is this particular line, which we call as the budget line. How many units of Y or how many units of X he can afford, given that his income is fixed. Now, what we have to see is whatever the consumer is going to enjoy is that particular indifference curve which meets the budget line. That particular that particular indifference curve which touches the budget line, probably this is where the indifference curve is touching the budget line. That is what is his utility maximization scenario given his budget constraint. Because see, this particular one is not fitting into his budget, so it is probably it can't be affordable kind of stuff. This particular indifference bundle, this particular indifference curve, the consumption bundle is not affordable for this consumer because his budget is not permitting. Whereas this particular bundle he may not prefer because it is lowering his satisfaction. So he would always prefer to have that particular bundle of goods and services which maximize his satisfaction levels in relationship with his budget constraint. That is what we say, that the consumers are very good at exhibiting the rational behavior. This choice will exhibit a kind of a rational behavior. So whichever that particular consumption bundle that maximizes the utility in context of the budget constraint is what would be the obvious choice for the customer. So it's basically I'm combining the indifference curve, which is a measure of the satisfaction levels of various goods and services, and the budget constraint. These two taken together, and wherever the budget constraint line is a tangent to this indifference curve, that is what we will take as that particular combination which will maximize the utility for this particular consumer. The other way to put the same content is if the consumer is more and more rational, his choice is that particular consumption bundle where the marginal rate of satisfaction, what is that marginal rate of satisfaction? Whatever he is willing to sacrifice, the units of A, marginal rate of substitution, whatever he is willing to sacrifice A for 1 unit of B is same as the slope of the budget constraint line. So that is where we talk about the tangential behavior. The budget constraint line is tangent to the indifference curve. That would be the obvious choice for the typical consumer. That will maximize his overall utility from the usage of that particular good or service. Right? Now let's look at another important context, which is called as stochastic dominance. This is again back to the investment theory. See, generally, from any customer perspective, any investment which gives the higher return is always preferred to an investment which gives a lesser return. If one particular investment, let's say I'm investing in stocks versus fixed deposits, right? Let's say I'm talking about two different investments. One is investment in stocks, the other is investment in fixed deposits. Now, if I say that the returns on stocks is always higher than the return on the fixed deposit, in all cases, if in all circumstances, whether the economy is doing good or economy is in a recession or whatever may be the situation, if I am able to say that the returns on stocks are much higher than the returns on the bank deposits or fixed deposits, then obviously my choice is for the stocks itself forever. So that kind of dominance of the stocks over the fixed deposits is what we call as absolute dominance. Obviously, at any point in time, any investor is going to choose stocks itself over the fixed deposit if that is being the behavior. But that cannot be the case. Stocks exhibit a lot of variability, volatility. In some cases, they may give much better return than the fixed deposits, whereas in some cases, people can lose heavily by investing in the stock market, means it is giving a lesser return than the fixed deposits. So, the scenario of absolute dominance generally is very difficult to observe. It may not occur at all in the real world situation. And that is where we are talking from the perspective of probability, from the perspective of relative likelihood. And that is where we will shift from the concept of absolute dominance. We are trying to shift to the concept of stochastic dominance. Right? We will not use absolute dominance because it is not that possible that one single security or one single investment criteria will always dominate the other one. So that is where we are looking at the cumulative probabilities. Whenever I am looking at two different investment opportunities, I'll try to compute the cumulative probability distribution functions and based on them I'll try to make the decision regarding the dominance. That is what I call as a part of the stochastic dominance process. In this we talk about two major aspects, one being the first order stochastic dominance and then the second order. The focus is simple. In the first order, the focus is more on the expected value, whereas in the second order, the focus is more on variance or volatility. So, a simple way to understand or explain the first order stochastic dominance is, from an investor's perspective, prefer more to less. Like a non-satiation kind of concept. Whereas when I talk about the second order, we are talking about more to less along with risk aversion being the behavior. So these two things go together when we are talking of second order stochastic dominance. The preference will be from more to less if I am going with the first order. So what we are simply looking at is, if the investor is preferring, let's say X and Y are the two investment opportunities that are available, what we are simply saying is X will dominate Y. If I am saying the cumulative distribution function of X is less than or equal to the cumulative distribution function of Y for all X, and at least for one X, for one value, at least for one or few values, we see that the absolute less than symbol is observed. So the probability that the portfolio Y produces a return less than a certain value cannot be less than the probability of the portfolio X producing that particular return. So for every possibilities, so especially where the variances are same, if the variances of two different securities are same, the one with a higher mean will have a first order dominance compared to the one which is having a lower mean. A simple way to look at, let's say I am looking at two different investments, right, X and Y. If I say that let's say when the economy is good, X will give 10% return and Y will give, let's say, 6% return. When the economy goes bad, I'm saying X will give 7% return, whereas Y will give 4% return. Now in this case, what I am saying is, in any case, whether the economy is good or bad or whatever it is, I am seeing that X will give a much higher return compared to Y. This is the case of absolute dominance. X is having an absolute domination over the Y. Whereas on other side, let me look at a slightly different scenario. Probably if I'm saying the same X and Y, I say that yes, X can give a 10% return. X can give a 10% return with a probability of 0.5 and an 8% return with a probability of 0.5. Whereas on the other side, I may say that Y is going to give 9% with a probability of 0.5 and 7% with a probability of 0.5. If this is the kind of a situation, what we are saying is the way I look at the first order stochastic dominance is I try finding out the cumulative probabilities less than or equal to that particular return. So I'll take, let's say, returns here 7%, 8%, 9%, 10%. And in case of x, what is the probability that the return will be less than or equal to 7%? It's almost zero. What is the probability that the return will be less than or equal to 8%? Half. What is the probability that the return will be less than or equal to 9%? Again half. What is the probability that the return will be less than or equal to 10%? This is 1. What about y? What is the probability that the return will be less than or equal to 7%? Half. 8% half. 9% 1. 10% 1. Now here what I am seeing is the cumulative probabilities of x at any point either is less than or equal to only, but it is never greater than, which means I can very well say that x is having a first order stochastic dominance over y, right? The stochastic dominance over y. That is what we are typically talking of, the first order stochastic dominance kind of a concept. Whereas when I am trying to bring in the second order, I am even bringing in the concept of risk averseness also, along with the non-satiation, preferring more to less. So the way we work out that particular concept is I integrate I integrate over all the values, over all the cumulative values, I try to integrate. So this is as good as saying the integrating over all the particular values, I am trying to integrate this particular x and similarly this particular y. Now if I am trying to integrate, it is nothing but it's a summation. So here it is 0, 1 by 2, 1 and 2. Similarly here it is becoming 1 by 2, 1, 2 and 3. Now here also all I could see is even from this dimension, this is less than this, this is less than this, this is less, this is less. All I am seeing is even the integration or the summation across the different layers for x, I am seeing that it is less than or equal to that of y itself, which means that even in the second order stochastic dominance is exhibited by x over y. So from an investor's perspective, since this particular investment is exhibiting both first order as well as the second order stochastic dominance, because all I am doing in second order is whatever are the cumulative probabilities that I have got for each level of return, I am taking the cumulative of them, 0. 0 plus half is half. I am adding another half to that, which is becoming 1. I am adding 1, which is becoming 2. So from a risk averse dimension, so now if the focus is more towards a risk averse investor, he is always preferring to accept a lower probability of a given extra return. So he wants a lower probability of a given extra return in preference to the same probability of extra higher absolute level of return. So probably he is not valuing both the gain and the loss at the same layer. He is giving more weightage to a loss compared to a gain. So if there are two kinds of return distributions which have similar levels of the expected mean value, The one that is having the lower variance of those two is typically chosen by the investor for his investment decisions. So what is clearly observed is the choice of the portfolios, the choice of the investment opportunities of the individual can be determined both based on first order stochastic dominance, where the comparison is on the expected value, as well as the second order stochastic dominance, which is based on the variance of the returns. Those two are taken as the input in terms of constructing the efficient and effective portfolios to the individual investors. So that is how we can use the various concepts of economics, the utility theory, stochastic dominance as the base for investment calculations and investment decisions. So if you have any further queries on this particular session, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.